What's a money move that sounds smart on the surface, but once you actually tried it, it didn't turn out the way you hoped? That's exactly what we're diving into today. This is part 2 of my series, 6 money moves that sound smart but aren't. If you haven't listened to part 1 yet, no worries. Each episode stands on its own. No requirements to listen to part 1 first, but I do recommend going back and downloading it so you have something great queued up for later. In part 1, you heard from 3 personal finance creators sharing money moves they don't think is smart, covering everything from credit card hacking to Roth conversions to 529 plans. Today, you'll be hearing from 3 new voices: Larry McMahon, Sean Mullaney, and Jeremy Schneider. They'll be sharing their takes on things like traditional 401k contributions and whole life insurance policies. But first, we're starting with Larry's perspective on why DIYing everything yourself might not actually be the smartest money move.
Hey, FI-minded listeners. It's Larry here from Uncontrollable Me, where we're all about helping everyday people become work optional by living intentionally and with purpose. Today, I want to challenge a quote, smart, unquote, money move that, well, might not be so smart after all. I call it the DEY versus DIY paradigm. That's do everything yourself versus just do it yourself. A lot of us in the FI community pride ourselves on being resourceful. We learn to cut costs, solve problems on our own, and stretch every dollar. And sure, that mindset can absolutely reduce expenses. But here's the thing. Reducing expenses is a tactic, not the goal. The real goal is to live our best lives to and through FI, using money as a tool to support our health, wealth, and happiness. And sometimes the most powerful move we can make on that journey is to ask for help. To make it a little easier to recognize when the time has come, I created a simple framework with the acronym HELP. It's a decision tool rooted in well-being, not weakness. Let's dive into it. H. H is for holding too much. You're carrying more than you can manage, mentally, emotionally, or logistically. E. E is for energy is drained. Your inner battery is low, and nothing's really recharging it. L. L is for losing clarity. You feel stuck or unsure about what's next, even though you've tried. And P. P is for patterns keep repeating. Despite your efforts, the same challenges keep resurfacing. It might be time for a fresh perspective. You may be thinking, I'd love to take a mini retirement, but I have no idea how. Or maybe you've already hit FI, and now you're wondering, what's next? Who am I without the 9-to-5 hustle? Some are navigating big life transitions, like marriage, divorce, or career changes, and feeling anxious about how it all affects their path to FI. The list goes on, but one thing is for certain. FI will present opportunities and options galore, which at times can be overwhelming, if not completely paralyzing. The good news: support is more accessible than ever, whether it's fee-only financial advisors for a portfolio review, or a tax professional for a tricky tax filing year, or a coach like me to help when you're just feeling stuck. Asking for help can actually speed things up, not slow you down. I'll leave you with a quote from the great Brené Brown that really hits home. Asking for help is a power move. It's a sign of strength to ask, and a sign of strength to fight off judgment when other people raise their hands. So remember, the path to FI isn't meant to be walked alone. It's about being intentional, leaning on the right support, and doing what truly works, not just what looks efficient on paper. Until next time, take care.
All right, Larry, I feel personally attacked here. But seriously, this is something I'm still working on. I love how resourceful the FI community is, but let's be honest, we often rely way too much on ourselves. Asking for help is not only okay, it should be encouraged. You're not expected to know or do everything on your own. Larry's help framework is such a smart tool for checking in with yourself. Are you holding on to too much? Is it draining your energy? Have you lost clarity on the big picture? Are the same patterns resurfacing? I just went through this framework and something clicked for me. Last month, I finished my taxes and it drained me. And honestly, I felt the exact same way last year too. Now I'm realizing it's probably time for me to reach out and ask for help. Sure, it might cost me some money, but it's gonna save so much stress. I want to apply that same mindset beyond just money. Maybe it's time to hire a cleaner. Maybe buying a workout plan instead of trying to piece one together myself is the right move. Here's the other thing that I'm learning too. Asking for help doesn't always mean spending money. The FI community is incredibly generous with their time and knowledge. You can join a Facebook group or check out a local Choose FI meetup. You'll probably find someone eager to support you. So here's my question. What's one area of your life where you can shift from do everything yourself to DIY plus a little bit of help? Larry is doing some great things for the FI community. If you're interested in his coaching practice, go check him out at uncontrollable.me. Next up is a frequent guest on the podcast, Sean Mullaney, and he's got to talk about why Roth 401k contributions might be the wrong move.
This is financial planner Sean Mullaney. I've got one money move that sounds smart, but isn't. It's a contribution to a Roth 401k for most Americans. Now, let me be clear. Having money in a Roth 401k is not a terrible thing. However, contributions to Roth 401ks need to be assessed against the most readily available alternative, which would be a contribution to a traditional 401k. And let's not discount the value of contributions to traditional 401ks. We're getting money in a tax advantage account for our future, which is great. It's tax protected, has creditor protection. That's great. Now, the Roth 401k has versions of all that too, so that's good. But here's the big one with a traditional 401k contribution. You get to deduct the contribution for income tax purposes. And the dirty little secret is most Americans are going to pay their highest tax rates while they are working, not when they are retired. Will that be 100% universally true? No. But that's likely to be true for most Americans. Because when we deduct into our 401k, we're deducting at our highest marginal rate during our working years. But then let's think about in retirement. When we're taking that money out, we are going up against the tax brackets. So it's going to turn out that a lot of that money, maybe we were in the 24% marginal bracket when we were working. Okay, we saved 24 cents on the dollar. But then when we take it out in retirement, maybe we'll go against the 10% bracket or the 12% bracket or even the 22% bracket. And you can sort of see where this is going. Many Americans are simply going to make out by doing traditional deductible 401k contributions. And there's something else. Roths are great, but they're best when we don't sacrifice a tax deduction. Roth 401k contributions sacrifice the traditional 401k tax deduction, but Roth IRAs usually do not. Here's the thing. The tax rules make it difficult, though certainly not impossible, to deduct a traditional IRA contribution for most working Americans. So if we're going to do Roth, why don't we do the Roth that does not involve us sacrificing a tax deduction? That's the annual contribution to a Roth IRA for many Americans. So I would argue that many in the audience should strongly consider the combination of deductible traditional 401k contributions and Roth IRA contributions and leave to the side the Roth 401k contribution since it sacrifices a tax deduction in a way that most Roth IRA contributions do not. Again, this is Sean Mullaney, and you can connect with me on my blog, FITaxGuy.com. You can also connect with me on YouTube at Sean Mullaney Videos, and you can connect with me on LinkedIn.
First, Sean's blog, FI Tax Guy, is one of my favorite go-to resources for learning about taxes. Because of that, he's been on the podcast several times. Most recently, episode 141, where we talked about how to access your retirement funds before 59 and a half. While preparing for that episode, I actually had a light bulb moment that changed how I think about Roth versus traditional 401k contributions. When I first started funding my 401k, I went with Roth contributions and thought to myself, my future self will not be mad if I just pay the taxes now. And honestly, I still don't regret it. Roth actually might have been the optimal choice since I wasn't earning that much. But as my income grew throughout my 20s and I moved into higher tax brackets, traditional contributions would have made way more sense. The last 2 years, I had shifted to traditional contributions to make better use of the tax break during my high earning years. This is especially relevant for the FI community. Many of us plan for years with little or no income after leaving work, which is prime time for doing Roth conversions at a lower tax rate. We talked about that in part 1 when Jesse talked through his smart money move that isn't quite that smart, which might be doing Roth conversions during your working years. So if you're pursuing financial independence and still in your peak earning years, it might make more sense to focus on traditional contributions to take advantage of the bigger tax break. Thanks for the tip, Sean. Last but not least is Jeremy Schneider from the popular Instagram account Personal Finance Club, rounding out this series with one of the best reminders about a not so smart money move.
Hey, five friends, this is Jeremy from Personal Finance Club, and I want to tell you about a money move that feels smart but isn't. It's investing in permanent life insurance. This type of insurance could be called whole life insurance, cash value life insurance, indexed universal life insurance, or IUL, variable life insurance. It has lots of names. They're always coming up with new names, but it's basically any type of life insurance where the stated goal is to accumulate a cash value inside of the policy. It's very different from term life insurance, which is a much more simple product where it covers you basically with just a death benefit if you die over a certain term. So a 20-year term policy says, hey, if I die in the next 20 years, my family gets this big death benefit. That's a very simple product, very low cost. But this permanent life insurance is usually about 10 times more money and comes with this web of rules. So maybe you've heard the pitch. You talk to someone, maybe they even call themselves a financial advisor, and they say, hey, with this product, you can get tax-free retirement. You can't lose money. Be your own bank, or infinite banking, risk-free growth. They basically pitch it as a clever way to take advantage of the U.S. tax code to bypass taxes and have this risk-free growth inside of this cash value inside of a life insurance policy. But that's not true. In reality, they're really long, complex policy with this web of rules designed to benefit the life insurance company, not you. Here are some of the problems. Number one, fees. When you get the pitch to buy life insurance as an investment, they never talk about the fees, but there's often fees like a monthly policy fee, a per unit charge, premium expense charge, indexed account charge. If you want your money back, surrender charge, and oh wait, the cost of insurance that generally goes up every single year. When they talk about the cash value that grows risk-free, that cash value is what's left after you pay all these fees. Oftentimes, when you make a premium payment towards one of these permanent life insurance policies, half of the money or even more could just immediately disappear to fees, and what's left is your cash value. Any investment that immediately loses half of its value upon making a contribution is not a good investment. Here's the second problem. Be your own bank. They talk about how, hey, you can grow this cash value and then borrow against it, thus becoming your own bank. But that logic is so flawed because the money gets so burned by fees. What's left is less than you could have just spent that money that was lost to fees instead of having to borrow against your own money. And I don't know how it's being your own bank, because when you borrow your own money back, you're not paying interest to yourself, you're paying interest to the life insurance company. And so instead of just keeping this cash in an extreme case in a checking account and just taking out what you need and putting it back when you're done with it, that's more like being your own bank than to give it to a life insurance company, needing to borrow it at an interest rate and then having to pay it back. So do not be your own bank. That does not make sense. Number three, outperformance. Oftentimes, these life insurance agents talk about how you're going to get better returns in a life insurance policy than in a regular investment like an index fund. That's simply not true. When you actually do the math, assuming everything goes really, really, really well, these policies can sometimes return like 3 to 4% many years out. In the early years, you're way into the red. You're at a loss due to the fees, right? And so you're not going to do better. You're going to do worse. The performance is going to be worse. And of course, you are accepting some volatility by investing in an index fund. But even on the downsides of that volatility, you're going to generally be better off than the guaranteed loss to the fees of these life insurance products. And number four is the risk of your policy lapsing. If you open up a Roth IRA, for example, and contribute $500 a month for a year into it, you'll have contributed $6,000, and that will grow forever if you don't touch it. If you do the same thing with a life insurance policy, buy a policy where the premium is $500 a month, pay into it for a year, and then you stop making payments for some reason because you can't afford it or whatever, that policy is going to lapse and you're going to lose everything. Again, this can't lose money sales pitch you're hearing is not true. So here's the bottom line. Sometimes these sales pitches make it sound like this really clever, smart move to take advantage of the tax code to put your investments into a life insurance policy, but it's not true. If you need life insurance because someone depends on your work, paid or unpaid, buy a term policy until your children are grown or until you become financially independent. Beyond that, don't give your investment money to life insurance companies. Keep your investments in investments and keep insurance as a tool to limit risk in your life.
Do I need to beat a dead horse here? Hopefully by now, the flaws of whole life insurance as an investment product have been well covered in your personal finance journey, but Jeremy's message is always worth repeating. Life insurance and investing shouldn't be mixed. Just buy a term policy and invest the difference in your favorite low-cost index fund. Why bring this up again though? Because life insurance companies are clever, and they're constantly reinventing the sales pitch. Be your own bank is one of those latest examples. I actually sat through an investment presentation a few years ago based on this premise, and it took me a while to realize they're just rebranding whole life insurance. Those tempting features Jeremy mentioned, like tax-free retirement income or risk-free growth, they all sound great. But let's be honest, if it sounds too good to be true, it probably is. Keep it simple, friends. From giving 529s the Heisman to realizing that you don't have to do everything yourself, I had a lot of fun learning from these other personal finance creators and creating this series. But before we wrap up, I want to leave you with one final money move that sounds smart, but often it isn't. And that's trying to get it right every time. Here's the thing. Personal finance isn't black and white. What's smart for you might not be smart for someone else. And what worked early in your FI journey might not serve you later on. It's all fluid. I kicked off this series talking about how I used a life insurance agent to manage my money. And yeah, his products weren't right for me. His 1% AUM fee and high-cost investments weren't ideal. But you know what? It got me started. And in the grand scheme of things, it didn't set me back that much. The truth is, you're allowed to change your mind. You're allowed to make mistakes. Maybe you chose Roth contributions when traditional would have made more sense. Maybe you overfunded a 529 and you're just now realizing that. It's all fixable. So give yourself some grace. This is a learning process. You grow, your goals evolve, and your money strategy can too. But now it's your turn. I want to hear from you. What's a money move that sounded smart, but just wasn't for you? Send me your stories. I'd love to feature it on a future episode. As always, you can reach me at justin@fiminded.com. I appreciate you listening, and I'll catch you in the next episode.